Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. And today we are going to talk about, of course, the CPI report that came out today. Before we do, I just want to say a quick word about the midterm elections and the importance of what happened. I think that obviously going into the election, there was much concern or elation, depending on which side you were on, about the potential for a red wave, that the Republicans would manage to get a substantial controlling majority in the House and or also in the Senate, and which would lead to divided government, which investors love because when politicians agree on stuff, it almost always costs us money. And so when they don't agree and nothing actually happens, then that ends up being good for investors, generally speaking. At this point, as I'm recording this, all of the results are still not in, which, by the way, is just truly a tragedy that in a world with this much technological acumen, we can't get accurate vote counts within a couple of days from all reporting precincts. But whatever. At this point, it looks like at best the Republicans will have a couple seat majority in the House, and at best we'll have a 1-seat majority in the Senate. But they also might have a 1-seat deficit in the Senate or be tied. To really know the answer to that, it's probably going to take another month or so and a couple of runoffs. But any way you slice it, it isn't a red wave. And but a lot of investors are pleased because if it ends up that the Republicans at least take the House, then we have quote unquote divided government. I think this is a misunderstanding of how this process actually works in practice. If a party has a substantial advantage and votes more or less as a unit, the party all votes together, then they really can block the other party. However, when you have a very close majority, and again, that's the best that the Republicans are going to have is a handful of seats, then whether or not you can block legislation from the other side comes down to two things. And there's obviously a lot more nuance here. Control of the committee process and things like that all matter. But at the end of the day, if legislation from the other party makes it onto the floor and gets voted on, you need two things if you want to block. One is you have to be able to whip your own party's votes very efficiently. And the Republicans have been notoriously bad at getting all of its members to line up in one direction and vote in opposition. And the other thing is that if you only have a 1 or 2 seat majority, it turns out that it gets very easy to peel off votes particularly for large fiscal packages, by just promising a little bit of pork. If I have to peel off 10 members, then that's just untenable. I've got a $1 trillion fiscal package. How much do I have to put in there in pork to peel off 10 members? And it's quite a bit. But if I have to peel off 1 or 2 members, then putting an extra bridge here and an extra municipal building over there that the government pays for, and that the representative can go home and say, look what I got for you guys. That turns out to be not that hard. And so practically speaking, the Republicans with a small majority can probably stop small legislation pretty easily. And so sort of the piecemeal approach in the passing of smaller bills, which is what the Democrats had been doing in the last Congress, will probably change. And probably it makes more sense to pass to try to pass large bills where there's a lot of room for pork and you can pick off those 3 or 4 people to vote the other way. Again, it'll end up depending on how big the majority is for the Republicans, assuming that it is a majority. But I actually think that the fact that this is a very closely divided government is actually very bad for inflation. We're likely to see much more deficit spending than you would think when the Republicans, quote unquote, have control of the Congress. And by the way, that is entirely consistent with the messaging from the Democrats prior to the election, which was, hey, we spent all this money, but that isn't what caused inflation. Putin caused inflation. The war in Ukraine caused inflation. Profiteering companies like the oil companies and the banks with their hidden fees, they caused inflation, but it really had nothing to do with us. And evidently, the populace bought that story. And so if that is in fact your view, and if you in fact do believe that, or at least that's the story you're telling, then there's absolutely no reason. If you don't think you had anything to do with this inflation, if you really do think it's a supply chain thing, then there's absolutely no reason to not go spend $1 trillion or $2 trillion if you believe in the modern monetary theory baloney. And especially as the economy starts to slow, already we're seeing it in housing. We're starting to see layoffs in some quarters. By 2023, we're going to be in a legitimate recession, and I would expect to see many trillions in additional stimulus spending. So that has nothing to do with today's report. That's just the backdrop. That's something to sort of keep in mind going forward. And it is very sad. The other thing that is important to know going into today's figure, I'll talk about that when we actually get to that part of the figure. So the report today was light. CPI was expected to be about 0.6 and 0.5 on the core. And in fact, it came in at 0.44 on the headline number and 0.27 on the core. So that's quite a bit lighter. In fact, that was the lowest core inflation number in over a year, and considerably off of the recent highs. However, it's not really as good as all that. Rents were still quite high. Rents weren't quite as egregious as they have been in recent months, but they were still quite a bit high, and there's no sign yet that rents have peaked. We saw a lot of upward pressure still from food and beverages, including food away from home, and recreation, other goods and services. But where we saw declines is what's sort of interesting. So it ended up being a fairly concentrated couple of things that caused this surprise on the downside. One of them was that apparel fell 0.7% month on month. Now, apparel is in core goods, and the sort of expected effect, we've already seen core goods start to decelerate for some time. And so that's not very surprising. The dollar has been strong for quite a while, and the lagged effect of a very strong dollar is that you get lower goods prices. Also, there has been, a decline in some, container costs, shipping costs, transportation costs, all of which tend to lower the cost of goods, and some of the supply chain things have started to loosen up a little bit. So we have, for example, new car prices continue to accelerate. Used car prices dropped more than new car prices accelerated, because back in sort of the teeth of the pandemic, new cars were not being manufactured very quickly, and so the only thing you could do with your stimmy check was to go buy used cars, and so that pushed the price of used cars up way, 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 way high, in some cases higher than new cars. And so we're seeing a correction of that, where new cars inflation continues to accelerate, but used car prices come down. and net a little bit of a drag on core goods. So the core goods was sort of a drag. Again, we sort of knew that was going to happen. But the other thing is, so I said last month, and I've said this now, I think a couple of months. One of the big things I've been focusing on has been core services ex rents. If you get rents generally right, then it's going to be hard to be very wrong on overall core inflation. And in fact, given where rents are, we're not going to have 2% inflation in 2023. It would require some just crazy movements in other things to get core inflation down to 2%, because rent inflation is going to continue to tick along at 5, 6, or 7%, and that's 40% of the basket. You're just not going to get overall core inflation down to 2. So that's rents. Services ex rents is all of the things where wages are a main input. And so, things like food away from home, lodging away from home, medical care, things like that, those all fall into, well, actually food away from home falls into food, but you get the point. All of those things where higher wages feed back into prices, core services, those things are now accelerating, are now rising much faster than core goods. Core goods inflation is coming down, core services is going up, not just rents, but core services ex rents as well. So, but one thing that happened this month, and I have to give credit where credit is due, there were some people, some economists who had highlighted this as a potential issue. It's going to take a little bit of explaining, so bear with me a little bit. It has to do with health insurance. So health insurance in the CPI does not actually measure the cost to the consumer of health insurance, which seems odd, but here's the problem. So in the CPI, we're trying to measure the cost to consumer of healthcare. But the consumer does not, in the United States, does not directly pay for all of their health care, or indeed very much of it. The way that consumers pay for most of their health care is they pay for insurance, and the insurance company then goes in and pays the doctor when care is provided or after care is provided. So in the CPI, you have things like doctor services and hospital services, and some of that obviously is paid by the consumer, but a lot of it is paid by the insurance company. And so when you're going and gathering these prices, you can call the doctors and you can say, okay, for this list of procedures, what happened to prices? And in doing that, you're picking up both what the consumer paid directly to doctors and what insurance company paid to the doctors. But there's still a leak there, right? Because the consumer paid the insurance company paid the doctor, but the insurance company didn't pay everything to the doctor. They kept some. That's known as profit. But it's a cost to the consumer. And so the BLS has to go and try to figure out what this profit margin looks like, and that's what becomes the health insurance part of CPI. And it's only about 0.8% of the overall CPI, which obviously is much, much smaller than the amount we actually pay to insurance companies. So the whole category is just really, really screwed up. But the important thing to understand is that hospital services, physician services, health insurance, all of those combine to equal what happens to medical care over time. So roughly once a year, the BLS goes out and assesses what is going on with insurance company profit margins, and they make this adjustment to healthcare, to the health insurance sub-item, and that basically every year every month for a year, you kind of have that same effect. Well, going into this figure, some people who had spent a lot of time really getting under the hood, and I don't, and I guess I'll explain why in a second, but had said, look, this is going to be a 4% per month drag. Health insurance, the estimate of health insurance margins is going to go way down, and it's going to be a massive, massive drag. Now, again, it's just 0.8% of the overall CPI, but 4% on that small of a category is still, not nothing. It would be roughly, 0.3 of overall inflation over the course of a year, or 0.45 or something like that. So almost 0.5% off of core inflation over the course of a full year. If, this is a really important if that correction was not reflected in anything else. That is, if this was just simply a major change in profit margins and not a change in an estimate in profit margins that gets counterbalanced elsewhere, which is to say, if the overall cost was up 5% in a year for medical care, I can call that 4% coming from medical care from doctors and 1% coming from the profits of insurers, or I can say the profits of insurers was really zero and it was 5% paid to doctors. Doesn't really matter. That adds up to 5%. And so to some extent, this is really just bean counting. Which category do we have to put this in? The real question is, hey, is medical care inflation going up or is it going down? And my personal view is that it would be really, really weird if at the end of this big pandemic, medical care inflation was going to go down rather than up. Possible, but Medicare just declared that they're going to be reimbursing doctors less going forward, and that tends to put upward pressure on consumer medical care inflation because doctors have to make it up somewhere, so they'll charge insurance companies rather than Medicare. So anyway, but it was a big issue, and it did come in like that minus 4% on medical care. So again, that shows up a little bit in core services ex rents, less rent of shelter, and yet core services less rent of shelter went all the way down to 6.42% year on year. So it was a very, very small correction. Again, it's a tiny weight. But when you kind of put that in there, along with apparel and some of the other core goods stuff, we ended up with a number that was quite a bit lower on core, not quite a bit lower, a little bit lower on core than investors were expecting. And so what does that do to the markets? What does that do to investors? Well, it got them very excited because if in fact you think that this means core inflation is now going to go up at just 0.25% a month, that's what it used to do. So yay, inflation is over. The Fed can stop tightening and everything is good again. Let's pump the brakes on that. That's very unlikely to be what happens. We are likely next month to be back at a 0.5% month on month. And so let's just pump the brakes a little bit. That being said, I think that what the story that the Federal Reserve is trying to tell itself is that, hey, we've tightened enough. We think that inflation is peaking. And in fact, inflation is peaking. Even median inflation is going to peak in the next month or two. But we think inflation is peaking, so let's tighten a little bit more, and then we'll just step aside and we'll just wait and see what happens. And so that's what they're going to do, is they're going to tighten 50 basis points at the next meeting, probably 25 after that, and then they'll probably be done for a while. The market believes that shortly after that, because we'll be in a recession, they'll start easing aggressively. I don't think that they will. I think that we will get rates to 5%, and then they're going to do their best to sort of hang on there at 5% for a while, unless markets get really, really illiquid or some other really bad thing happens and they have to actually go and, banks start to fail or something crazy like that. There's no real sign of that at this point. I don't think they'll respond to a higher unemployment rate by aggressively cutting rates. But that's obviously all that is an issue for next year. For now, markets are super excited that we can see the end of the Fed tightening. That means the dollar is on its butt today because if the central bank of the United States is no longer the most aggressive central bank, then that means some other central bank is going to be, which means that their currency will do well. Whatever, I'm not an FX guy. But lots of big moves today. I suspect that over the next couple of days, we'll see Federal Reserve speakers tell people to pump the brakes a little bit. And so I think we'll probably retrace this 1,000-point rally in stocks, and interest rates will probably, longer-term interest rates will probably go back up and a little bit. And, so I wouldn't worry too much about this. So long story short was this number was certainly better than expected, but the big parts of it are still doing all the wrong things. They're going to peak soon, and those numbers will come down, but they're not going to come down nearly as fast as economists are forecasting, and it's not going to come down nearly as fast as today's number would suggest if you project today's number for 11 more months. So that's where we are. Let's hold our horses just a little bit. And that's all for today's podcast. That's all I have to say about the number. You can contact me at inflationguy@enduringinvestments.com. Follow the blog, inflationguy.blog. Follow me on Twitter at inflation_guy, or visit enduringinvestments.com to find out what we do, both as investors and as consultants. And most importantly, never forget, even when things are looking like they're a little bit better, you should still defend your money. And if inflation is coming for you, remember, you know a guy.